Let's leave that there, eh? Hey everybody, and welcome along to the Sunday market update for today, the 14th of November 2021. It's great to have your company, and my name is Paul B. I'm the founder of Actions to Wealth, and I'm going to do a very quick introduction before we go to Julian. And Julian, I am pleased to have you in today. It's going to be great to have the team go through this market and talk about it, but particularly for yourself, mate, what a weird week. The US dollar actually finally broke out and put a directional move in. Meanwhile, Bitcoin, well, broke out, backed off, and went absolutely nowhere. ETH, about the same. The NASDAQ, which we all thought maybe was pulling back and heading for trouble, put in 2 solid days to finish, as did the S&P, and they look bullish again, which, boy, and the dollar and gold, the dollar's gone up and gold's gone up in a row. Now, that is interesting for mine. I don't know how something valued in US dollar goes up when the US dollar is going up like it is. There's some real strength underpinning that gold move, in my view. And oil, which, of course, has been doing nothing but going up for ages.
Now trades like a dog. Yep, there we go.
Everything's back to front, Julian. Everything's wrong this week. Nothing is normal. Make some sense of it for us, will you?
Yeah, I'll do my level best, guys. Hey, look, welcome everybody, wherever you are in the world, to I guess the macro overview. Now, look, I think the key thing for me is to be, how can I put this? I'm getting worried. Everything I see, every piece of real economic data is not very good at the moment compared to expectations. We had a slightly higher inflation number during the week. Yeah, okay, yada, yada, right? However, let's unpick some of this, right? The unemployment cliff that happened in the States as everybody has lost their jobs or lost their unemployment benefits the government was giving them is finally coming home to roost. We saw that in consumer sentiment on Friday. It was rubbish. Now, we're just coming up to Christmas. What are we? We're now 10 days away from Thanksgiving. We're 6 weeks away from Christmas. This is the peak shopping season time, and yet we're seeing consumer sentiment down. What does that tell you about two things? About Q4 earnings for some of those retail companies, and also about the way people are thinking about the economy. This is a worry for me in the US. Now, if it was just the US, I'd be going, yeah, okay, look, let's just park that and we'll get on. But I want to just highlight one quick economic fact that I've been looking into this week. So imports in China, let's take a very simple thing, right? One of the core raw materials, imports of iron ore. You look at the iron ore value, right, of what's been coming in, and look at the actual numbers. You go, oh my God, look, things are amazing. There's like last year it was 10 billion. This year it's 20 billion. Imports are up enormously in China of iron ore. And then you go look at the actual quantity of imports, and they are flat to a year ago, 2 years ago, flat to 2 years ago, and down somewhere in the region of 20%, 25% on this time last year. So the actual number of imports, the physical volume, is down. Okay, the numbers are higher because, of course, the price of iron ore is up a little bit. So here's the challenge that we have, right? And I keep coming back to this. The dollar is up. Why is the dollar up? Because people have got to pay those invoices from when all those commodities were crazy prices 6 months ago. Do you remember that back in May when there were crazy prices for things? Iron ore was trading up at over 200 or something dollars a ton, and now it's at 90. And then we've had the run up in the energy complex with natural gas, and we've had, if you happen to be buying electricity in Europe, I'm sure you're not having a very good year either of the last couple of quarters. So all of those things have come back off again, but the bills and the invoices have come due. This is my version of why the dollar is on its way up. People just need a lot of them. They've got to pay the bills, right? 80% of the world's invoices are in dollars. So when I look at this, I'm not surprised by the dollar breakout higher. We've been talking about this. I think the whole team flagged this either last week. It was 2 weeks ago. I think we flagged it. Gosh, I can't remember these days. Sorry, Auckland's been in lockdown for so long. Every day blends into the other one. So the The team flagged this a little while back that the dollar was probably going to move a little higher and the euro was going to move lower. I think as all of these things, I go, yeah, okay, that's playing out. The question in my mind is how long does it carry on for, right? And does it accelerate? So for the time being, you look at the weekly charts and you look at daily charts, you're not really going to try and fight this mini trend for the time being. So let's not try and fight the mini trend and let's look for opportunities wherever we can. So at the moment, for the time being, the dollar is on a run and it makes sense to be long of US dollars. I don't think it makes sense to be long of the US dollar against the Aussie. I know that that's performed reasonably well, but I still think the Aussie is in a much better place as a currency compared to something like the euro or compared to something like the British pound. So in my mind, right, we continue to look at this. When you're looking at the dollar index, then that often mimics the euro and mimics the euro, the Swiss franc, and mimics the euro, the Swiss franc, and to some extent the Japanese yen. So unsurprisingly, we've seen that breakout and we've seen that breakdown in the euro. Dollar Swiss is clearly rallying, and dollar yen is also come back a little bit. I think it jumped a big figure on Thursday. So you've got all these things taking place. You know, right now in the short run, just keep playing that. I think the sell-off we saw in the dollar, the slight pullback on Friday, was probably just end of week profit taking by those people that had the right position on. I'd look to think on Monday, Tuesday, Wednesday, we should probably trade higher again. That makes sense. But I'm not sure how much higher, right? So when we look around at opportunities and things that are going on, if I see the economy starting to struggle, that's a warning sign for me with stocks. You know, you guys, you've listened to me for the last couple of months around this. Looks like an analog to me of 2007, 2008. Guys, go look up what happened to the stock market in that point in time. You know, the GFC didn't just happen in 2 months, right? It took 2.5 to 3 years to spin out. A lot of people lost a lot of money in 2007 shorting that S&P into the end of the year, despite the fact that things were clearly not right. The stock market kept on going. And I feel that we've begun to see that now. You know, look at some of the speculative stocks, right? Look at the Teslas, right? That's off, what, 20% in the space of a few days. The volatility is starting to pick up. So this is one of those times where, as I continue to do, I have done for the last 2 months, I continue to tell you to remain cautious in the equity markets. I don't understand what's going on. The real economy is telling me one thing. The equity markets are telling me something different. When I have that dichotomy, trade it, take the wins. If you get it, take the wins, right? But just be aware that at some point in time, gravity will work in the same direction, and something's got to happen. Either the economy picks up, or else we're going to see a problem. Okay, so the dollar rally. Traditionally, a dollar rally is not very good for the world. I really think it's related to money. So why don't we park that discussion for the time being and not try and relate it to an economic issue? I think it's just purely a monetary issue. And then finally, we've got, when you start to think about what else is going on, the energy complex is beginning to look like it may be rolling over, but we're a long way from entering a bear market there, a long, long way from entering a bear market. So who knows what's going to happen? The obvious candidate for the week, the obvious play right now is what's going on in the precious metals and most notably gold. And, you know, we've been talking about gold and gold miners for some time now. Gold miners have been particularly cheap. And it's a safe haven. Guys, if you're thinking about equity and you've done really well in the equity markets, why not think about reallocating something back to the boring assets, right? And gold right now seems to be a boring asset. Okay, yes, it's doing reasonably well, and that hopefully that's going to continue, and it might start to form some kind of major rally in here. But I think the money that's moving into gold right now is moving into gold from a defensive point of view, not necessarily thinking that it's a brand new run. Okay, maybe that will be the case. Ainslie will tell us in a few minutes what's going on in that market. But I see the overall asset allocation to gold as being somewhat defensive by people who need to park money somewhere because they don't want to put it in cash because it doesn't pay you any interest. So listen, just bear these things in mind, right? We need to look at that real economy. Just look at what's going on and see what's happening in the real world, right? Yes, of course. Some goods demand is much, much higher than it was this time last year, but that's because two reasons. Number one, people are ordering more stuff. We see that. You just got to look at those containers coming into the ports in California and the ships that are held up waiting to get into port in China. There's clearly a lot going on, and we know that goods demand in the US is running at something like 30 or 40% above what it normally would be this time of year. But those are deliveries. That money's been spent. Those things have been bought either by corporations rebuilding inventory or by people, for final purchases. And once all that is done, why then, if goods volumes are so much higher, are we seeing consumer sentiment being so poor? This is where I have these problems. Okay, there's a paradox in here that I can't find an explanation for apart from the obvious one. People lose their unemployment subsidies from the government. 8 million people over the course of the last 7 weeks have lost those subsidies from the government in the States. Is it surprising? Is it surprising then that we're seeing consumer sentiment start to fall away? Is it surprising then people's inflation expectations are nowhere near the actual rate? Is it surprising then that people are starting to get out there and complain about just about everything? Okay, so no, none of those things are surprising to me. People are angry. Angry people don't turn up in the middle of a boom. It just doesn't happen, okay? Angry people turn up when there's something really bad to shout about. And I think it's happening through a lot of jurisdictions around the world. So this is going to be fun the next few months. We've already seen some great trading opportunities in the foreign exchange markets the last couple of weeks. Maybe this is gold's turn now. And for those of you who've been following, Ainslie and I did an amazing piece. Go check it out on YouTube. Paul, maybe we can maybe flick the link out again to people after the week that we've had in gold. The show that Ainslie and I did, I think about 3 or 4 weeks ago, where we talked about the gold market, how prescient that was, guys. Okay, we did that show, and now we're seeing gold starting to perform. All right, this is why these things and these shows are so exciting. We don't just put them on for fun. We begin to see that asset allocation. We want to share it with you guys. We can't give you direct recommendations on these shows, but we can point to what you should be thinking about doing. And let's see where that journey takes us in that asset. And as I say, the stocks, the golds and mining stocks have been cheap as chips for ages. And if you look at it, there's a super long-term trend in gold mining stocks. We just about touched that trend line before we bounced over the course of the last 3 to 4 weeks. So there's some really interesting things going on in that space. As I say, Ainslie will talk more about this in a minute. But for me, the macro picture is going from mixed to slightly negative now. And I do not understand why. Well, I do understand why stocks are going up, because they always go up this time of year. This is a seasonal time for it. But I'm going to amber on my alert signals. I'm concerned. I don't understand this difference in the real economy versus the difference in the financial market. Something's wrong. I worry it's an analog of 2007. That's it for me, Paul.
Cheers, Julian. Interesting stuff. Thank you very much for that. And I will get that link and get it posted into the chat not too far away. Next up, we've got Alexis on fundamentals. And after that, we'll have Ash on data. So next up is Alexis. Alexis, it's still a fundamental market, isn't it? What have you got for us this week?
All right. I think it's pretty interesting that Julian mentioned iron, because I was kind of looking at the Australian dollar. So a couple of things I would like to quickly share with what I would like to look at this week is, will the Aussie dollar continue heading towards the upside? So the first thing we have to know is, if you are trading the Aussie dollar, you kind of have to know what they spend on, and you can see that they actually spend about 35.9% exporting iron ore, right? So if I'm actually looking for what's moving forward, what kind of iron news that we're kind of look at, then a couple of interesting headlines would have come up for me, which is over here. This was done 2 days ago. It spoke about how iron ore has actually slumped, all right, over the last couple of periods. So this is a iron ore chart from Financial Times. You can see that iron has actually just dropped off very drastically in the last 2 weeks, actually, from 120, and now it's just about 95-ish, right? So the question then is, who is the largest importer of iron ore? And that is actually China, right? So when we talk about China being one of the largest importers of iron, and we have this big price drop that happened previously because of the Evergrande scandal, and for whatever reason, the question now, I would say that, will this mean that Aussie dollar will continue going down, or being Chinese, right? Being Chinese, we know a cheap deal when we see one. So if you are if you are in any kind of sector that requires iron ore, and you see price, pump down all the way to 90 plus, right? Being Chinese, you will think, hey, this is actually mean I can get my I can get my iron cheap, right? So the question is, if there is a potential of buying over here, if iron is cheap now in comparison to the last entire year, you can see that the last entire year, if I just stretch out a 1 year chart over here, you can see iron has been 120 all the way to 200, and then now it's back down to below the so-called average-ish price. Iron is actually considered cheap right now if you just compare it to the last 1 year. If you look at a 5-year chart, you can see that iron is very near to its lows of 2020. So there will be potential buying opportunities here if the China economy is continuing to recover and expand from COVID, right? So when we look at the charts, I always like to compare. The two currencies where we have the the Australian USD over here, and I like to compare it together with the Chinese yuan and the USD. All right, I'm just lining it up to Chinese yuan and Australian dollar. I'm just lining up the months here to get a kind of a perspective on it. So if you look at the Chinese renminbi chart at the bottom, it is kind of hitting a very nice key level, very, very bullish price action looking. This kind of indicates that there is potential for the RMB to kind of pop above here. I will be very interested if that happens on Monday, because what it means that people are going to be buying the Aussie as well, which means the slight correlation has potential over there, which also means that we could see potential continuation of a buying of Aussie dollar. So for the next 1 or 2 weeks, I'm going to look for an opportunity to buy the Aussie, of course, waiting for its its pullbacks. And if we do just look at the other Aussie positions, right, you can see that it has come down, it has retraced quite a bit based off the bad news that's coming out from the China correlation. So there is kind of a buying opportunities off at these certain horizontal levels. So I will be interested to see whether there's buying opportunity for the Australian dollar. I think last thing to note is this. I found this, which is a bit interesting, because I am actually watching the USD as well, trying to figure out why the USD actually went higher. So this is a Peterson G Foundation. They actually have a running count of what is its current national debt. I thought it was quite interesting. So basically, if you break down this $28 trillion in national debt, it's about 87,000 of debt per person in the US. And of course, it goes to question now that where will the USD go? Will this USD run continue? I think I just want to look at certain interesting levels, and I'll use my favorite US dollar sing to kind of look at this, because I think what's really interesting is for the last, I hope I saved it. Okay, I did. Okay, for the last, I'm going to use a weekly chart, quick one for this one. Okay, for the last 10 years, all right, for the last 10 years, I've got little arrows here that tells you, when we come into the year-end seasonals, all right, what is the seasonal move of the USD against the Sing dollar? So if we start off in 2010, where the recovery of the market kind of started, you have, the first part, we have increasing US dollar strength coming to the end of the year due to these seasonals. With a couple of years, it went flat. And then the last 3 years, 2018, 2019, 2020, into the COVID years, we have the end of the year seasonals where the dollar started to weaken, right? And then, of course, coming to 2021, you have, what catches my eye is that, it's very, very flat. It's very, very flat with very little steam towards the upside. So my question would be, with the ballooning national debt, will the US dollar still be able to continue its rally moving forward towards the end of the year, into the new year? So I think, like what Julian said, there is something interesting boiling up in the stock market, in the equities market as well. So trading USD, probably be a bit more cautious right now, because there is something boiling, and it's going to be. I don't think the USD will continue to pump up very, very much longer, especially if there's nothing done to nip the debt in this 28 trillion debt in the bud. Yeah. So that's all I have, Paul.
Cheers, Alexis. Thank you very much for that. It continues to be an interesting old market we look at, isn't it? Thank you very much for that. Look, let's go next to Ash and talk about data, seasonals, COT, fundamentals as well, mainly seasonals and COT from Ash. Ash, what's the market telling us this week? I can see we've got some COT and seasonals up there.
Yeah, well, I just want to encourage everybody to go back and watch Julian's piece again, because it's always difficult, I think, every week to kind of go and say, okay, what's the really important stuff here? You know, what should I really garner from this? But everything that Jules said this week, I just think is so poignant and so on the money that that I think we need to sit up and listen. I mean, I'm going to do a whole piece tomorrow in the show on a couple of gold stocks, because I think we need to be prepared for this stuff. And there is movement when we look at the stock market, individual companies. There is movement, and now we know about the what's happening in the gold chart. But now we can go and start look at some of the detail, and some of the detail is going to be some of those stocks. So go back and watch Julian's piece again, because this week particularly, it's always very, very poignant stuff. But this week particularly, from a personal level, Julian just hit the money every single time. The buttons were going off in my head with just about everything he said. So let's just strip down what the COT data is telling us, because the COT data is going to point us in more in more of a certain direction than others. It's going to be more pinpoint in certain aspects of what's happening than it is others, because things will all move together ultimately, but they will move at different paces early on. So if we do have just a quick look at the gold market, on the COT data is not really there yet. You know, I'm interested in what where gold is right now. I think it's at a really useful level to start thinking about building positions. Same with silver. It's not there yet, but by the time this stuff catches up, because remember, we're almost a week behind every time we get this data, 3 or 4 days behind at least before we get the data. Then the moves may well have happened. But so we're still watching out for it. It's saying it could be a shade early. When we look at the seasonals say the same thing. It could be a shade early, but it does look like it bottoms out around about the middle of this week coming. So sometime around about this week, we may well see a low kind of created. We may have seen that low already, but we may see a low of the current trend, which is just started to push to the upside on some of the shorter term timeframes, the 4 hour and the daily, and then we see that bottom out and then really start to go. But the products that I want to draw everybody's attention to this week is the stock market, because the stock market is really starting to show signs of stress. Now, whether people go and put their money in gold is going to be the question. The other answer, of course, if you don't want to go and trade gold and go and buy gold stocks, is to start getting bearish on the stock market. And the stock market is at those levels where it is dangerously high. Again, really poignant piece on that Jules said about the stock market. Very, very high when it comes down to some of the metrics that we need to suggest that the bull run's going to continue. Those metrics are very weak. You know, consumer sentiment was a terrible number, and we had this rally in the stock market right towards the end of the session. But it was a bit of a shocker for me, considering that we had that CPI data, which was so high. You know, you've got people effectively paying more for their goods, and you've got a lack of confidence from people about what they're going to do about spending money. What that will tend to equal is less buying. Less buying means businesses don't make the money. Businesses don't make the money, stock markets come down, because people then start worrying about the fact that they're not going to get their dividend yield that they would have got before. You know, that's when earnings start. So that's when the stock markets start to get a bit flabby and overvalued. And look at the NASDAQ, very close to the 20% mark, 28% on the 36 month, 28% on the 18 month, 25% on the 6 month. So very close to the 20%, where it says the COT data is now in the extreme zone where the bears may well start to come into play. The S&P, even more interesting, 36% on the 36 month, but 0 on the 18 month and 0 on the 6 month. So the COT and the commercial traders are saying we're not interested in the S&P at these particular levels. Still relatively interested in the NASDAQ, relative to the S&P, but still, coming down. But when it comes down to the S&P, it looks like this is where the stock market may well find problems, and you're really trying to figure out, the S&P is made up by many of the stocks in the Nasdaq. You're really trying to figure out, will it be a tech story or will it be something else? What Jules is saying about Tesla, difficult one with Tesla, very, very difficult, because it's so volatile. But there are other performers, there are other companies in the Nasdaq that latterly in the earnings season just haven't performed. We had some decent numbers from some of the big guns early on, but latterly in the with some of them, PayPal and Facebook and companies like that, they haven't performed in the way that that the expectation was built to produce. So let's have a look at the seasonals on the Nasdaq and the S&P, because this is where I'm drawing my eye. These two particular areas. Dow a little bit different, 51% on the 36-month, 16% on the 18-month though, and 29% on the 6-month. Does suggest that the early kind of trend may well be running a bit hot, and we could start to see some profit taking here. S&P in November, pretty flat. If we're looking at this, it's pretty flat until around about week 3. So towards the end of the month, yes, we may well see that rally if the seasonals are to play out. But what the COT data and the seasonals are kind of lining up is that there could be some profit taking in the next week or so. It may go deeper and it may last longer. And considering the metrics, it should. But the metrics don't always line up with what traders are doing. But it's certainly saying that that over the next week, maybe the next week and a half, S&P does not suggest that we should be jumping on board with a rally to the upside, with a move to the upside, and maybe even taking some short-term positions to the downside. Nasdaq, similar. Very flat during November. You can see that November starts here, but after the first few days, it gets pretty choppy until around about the end of week 2, the start of week 3, and then we do tend to see that rally come into play. So be very, very careful out there. But I would suggest going, overlaying again what Jules is saying. Gold, silver, really interesting for upside. Stocks, quite interesting for downside. And I think that those moves could be pretty swift. They may not turn it into a bear market, but I think that there could be some short-term opportunities that actually bring us to the downside in the next week.
Cheers, Ash. Thank you very much for that. Interesting to see what the numbers are bringing us all the time. Certainly, this is a fascinating market, isn't it? Traders sometimes don't like it when it goes sideways and don't like it when it moves. And really, there's some opportunity around right now. We should be enjoying every bit of it.
Absolutely, mate. And I suppose this is the thing. The sideways consolidations are where people get caught out the most, because they do continue to expect it to either trend in one direction and the other. And I guess that's the point with the S&P and the Nasdaq. The range is actually quite wide. It's quite a big range. So even though it comes down, which I suspect it probably will, even though it comes down, it doesn't necessarily mean that the market trend has turned. It just means that we go from the top of the range to the bottom of the range, which is pretty wide at the minute.
Yeah, and time for and then perhaps some seasonals to come in later in the month and see if they want to move back up again. Be interesting to see how it does unfold. Look, we've got a bit of a treat today. We have got Julian coming back. Julian's going to come back and do gold for us. Julian, welcome back to the show.
Hey, Paul.
Hey, mate, how you doing?
I'm good, thanks. I'm good. Ainslie has had a couple of little local difficulties. So, guys, you've got me. And I'm just going to try and just share my screen here and get gold sorted out. So let me tell you the Julian way of doing looking at gold, which I'm sure will be slightly different to what Ainslie normally tells you guys. But I hope you can just bear with me as we run through it.
Here's your screen coming in now, mate. All good.
Okay, cool, guys. Okay, look. So. Technicals, okay. I've got on the screen. We've got in front of us. This is a daily chart, and this is two things, right? That I have to immediately point out to you guys. Number one, so the Bollinger Bands are widening, right? That's a pretty key bullish signal. Okay, so when you have this widening of the bands, that suggests two things: not the volatility is going up, it suggests the market is becoming one directional. So We need to really focus on that. Secondly, are we above some moving average lines? Yeah, you look at the 10-day, you look at the 20-day moving average, we're above it. Both of those are bullish signals. Okay, so from an analytical point of view, we can say quite easily that gold is in an uptrend. And let's just look at the bars. We take off the technical picture and we try and look at some of the bars. Let's see if I can hopefully just kill them. I don't know if I can kill these things. Hang on. Here we go. Let's get rid of all of that and just go straight back to looking at the bars here. What do you see? Okay, you see, conveniently for everybody, I have posted the up bars as in green and the down bars in red. We have got 1, 2, 3, 4, 5, 6, 7 straight up bars in green. Okay, this is about as strong a definition of a trend as you get. Does that mean we're going to have an up day on Monday? I have absolutely no idea, guys, and I'm not sure that we should try and think about it that way. What we're looking for, because we're in a uptrend of a kind, is to try and manage to try and pick up gold on a retracement if we believe it is in a uptrend. So from my perspective, when I look at this, it seems very clear to me that we're heading up. We've got lots of closes in the top of the range, lots of opens that are below the close and lots of closes in the top end of the range. So very strong set of buy signals in there. Combine that with those technicals, we see the moving averages, like I say, 10-day, 20-day moving averages sitting well above those lines. Bollinger Bands breaking out. Okay, it doesn't get any better than this. So the question is, what do we do? Well, that's why you guys all have trading methodologies. Use them for the time being. The trend is up. We're seeing an acceleration of the trend that we saw over the course of the last 3 to 4 weeks. And we're now starting to see the market move ahead. Why don't we have a quick look at those miners I was talking about? Okay, so I just want to show you one thing. For those of you that don't have an opportunity to go back and see my report, let me just see if I can make this a bit bigger. Okay, this is a weekly report, a weekly chart of the GDX, which is the ETF for the large gold miners. Again, looking at the weekly chart here, you've had one down week in amongst 5 up weeks. Okay, so again, a trend is starting. Try and find another analog for that elsewhere. And you sort of go, oh, look, there's one here, and look what happened to that trend. Looking for it elsewhere, you try and find some analogs. That was only a small correction there. We're really struggling to find this type of directional move 6 weeks with only one down week. You're starting to see some really positive price action. When was the best time to buy? Look, it was obviously in the gold stocks, that retracement we had a couple of weeks ago. We're looking at here, right now, is on that weekly chart. We've seen this 1, 2, 3 corrective 4, 5. Are we anywhere near any kind of resistance? That's the next question you ask. Well, let's have a look, right? You know, we've got a lot of work to do here, right, to get this market rocking and rolling. If you're looking at the GDX, you've got to clear 36, you've got to clear at least 30, 39, and then you have to think about targeting that 40 level. That would be, for me, on the miners, the key place. When we go look at the gold chart, what are we looking like in the underlying metal itself? Clearly, 1917 is our first point on the weekly chart. There's our initial target. Why is it a target? Well, because, guys, we've cleared everything else, right? This is the definition of what a breakout looks like. Where are we wrong? We're wrong if we go back inside this range. So we take out the lows of last week. We're probably wrong for the medium term. Wrong for the short term, I mean, maybe still right for the medium term, but wrong for the short term in terms of the gold market continuing. So think about it this way. Your stop loss is the lows of last week. Everything else beyond that, what you're looking for is probably heading up to 1920, maybe testing those highs up at 1960, and who knows where it's going to go beyond then. You know, I don't want to paint too much of a bullish picture because I'm not, you know, predicting where price is going to go is not a great suit of mine. What I can see is that we're seeing a positive price action. We've got to enjoy the journey. There aren't many markets right now which are trading as well as gold is at the moment. And that, as everybody on the show has also pointed out, is quite unusual. It's quite unusual given a rise in the US dollar at the same time. So these things don't tend to correlate as well. So that's also interesting as well. So number of different reasons to like gold. I haven't looked at the short-term stuff. Paul, I can probably drill down to the 4 hourly if you'd like me to have a quick look at that, but I think probably that gives you enough of a picture for the time being.
Yeah, mate. Let's. I think as much as it would be nice, I think the 4 hourly maybe after a weekend, perhaps the timing of that needs to be held up a bit anyway. We don't want guys entering on 4-hour bars first thing Monday morning, right? They need to have a bit of a look at this. I love what you say, Julian. It's an interesting chart, and it's one of these things, where if you're a gold trader, you've had no opportunity now for, well, basically for 6-8 months, and when the opportunity comes, you've got to take it, right? And there's an opportunity there, boy. If you can get it from here, she looks great.
Paul, this is the first positive market in gold since July of last year.
Mate, while you've been talking, I've put some money in my Sharesies account. I'll be buying gold miners on Monday morning. As soon as the US market opens on Monday, I'll be having a look at those gold miners because, as you know as well, we've got a good friend Leon who also has a bit of interest in this kind of stuff. His specialty is gold miners or gold and commodities, and he's also talking gold miners to me, and it makes me think, time to get into that. I might be too late, but I'm hoping I'm not too late. I wouldn't mind getting into this.
Look, and guys, if you like the spec side of things, there's GDXJ, which is the junior gold miners. These are the guys who tend to be a little bit more unhedged, so you get a bit of bang for your buck leverage wise with the junior gold miners. So there's two main ETFs, GDX and GDXJ. I'm sure there are others out there, and gosh, if this market trend starts to develop, they'll launch ETFs like crazy. But these are the old family, the old familiar ones that I know very well and have been trading for a number of years. So if you are thinking about gold, without putting a recommendation to everybody's head, I wouldn't go much further than those two.
No, it's one of those things, isn't it? That there's a bit of an old saying in trading. It's that it's never the right time to buy a high unless it is. And I just don't buy market highs. I don't like buying market highs. But every now and again, you look at a chart and think, actually, we'll see how this opens on Monday morning. But I'll be looking for an opportunity to get into this, and it's very rare for me. If it's not Bitcoin, I don't buy market highs, and I don't mind them in Bitcoin because it doesn't really care what the price was 30 seconds ago. Bitcoin, it just goes in different directions. But that's a decent pullback, isn't it? That is a decent pullback.
Look, if you look at the bigger pictures, you're absolutely right, Paul. So guys, why don't we just spin this out a second and just let's take this crazy, right? Let's go look at the monthly chart, right? And that, if you looked at that and stuck that on any other kind of chart, if you said that's a weekly or that's a daily, I think pretty much everybody would say that's a consolidation that may be starting the next leg up.
Yeah, it looks nice, doesn't it?
Probably one of the more positive markets that are out there right now.
Do you happen to know? Are you coming back to the oil in a few minutes? You're going to go.
I'll give oil a go if you like, but I don't know if Ainsley's having some difficulty with some things back at home.
Hold on, mate! Don't share that. Mate, you're sharing Ainsley's Skype. Just drag it down, please.
Oh, sorry. Yeah, apologies. So guys, look, I'll come back and do oil if Ainsley's still struggling, and that's fine. We'll cover it then. But I think we got the message on gold. There's no need to go any further on that one.
Cheers, mate. Thank you very much. Had a great session from Shukri today for some of the West people who do that session on the $1 million trade that he thinks is coming up. Always interesting to hear what Shukri has to say. We're talking crypto with Shukri next. I'll be playing the recording from Shukri today, and then we'll be back with Julian to do oil. Julian or Ainsley to do oil. Are you ready to go?
Okay, let's start for this week. So what is Bitcoin doing? Nothing, but it did something very crucial this week. You see, this is the 12, right? This is today, 64,304, 64,235, almost the same. But what it did since last week is this. There was a CME gap, There was a CME gap, and true to form came back, closed it. Okay, so I guess now we're ready to go back up again. So it has done what it was supposed to do, because if not, people will always look at the CME gap and wondering if it will ever close it. It's done closing it, so we are basically ready to go up again. But there is an alts rally going on, okay, while BTC and Ethereum kind of like go nowhere. You see alts like AVAX going up. This is already all-time highs here. So what do people say about Bitcoin? Look, 90K is in the coming weeks despite pullback. I think we know now that the target for November is 89K. So it is really going as to what the plan is, right? 85 to 90K. The plan by plan B, right? So again, as we attempt to break out a previous highs this year, setting up the prospect of a potential parabolic run up as we saw in the last stages of the last bull run, and there is a taproot fork coming on the 16th. Is it again? As I said, I do expect something to correct, and then we go up all the way until we hit the ATH. Minor corrections along the way, because this is the thing that happened during SegWit in 2017. So yeah, just hang on tight, prepare for that last hoorah. That's it for today.
Thank you to Shukri for that. And I understand we'll be heading back to Julian to do oil. Julian, are you with us?
Yes, I am, Paul. And
welcome back, Matt. It's the Paul and Julian show today.
I'm happy to do oil as well too. Crikey. Okay, guys.
I don't have to dump this one on you, but last week I said I thought oil was a professional traders market. That the Cushing, Oklahoma thing was just too complicated, and that retail traders just need to be a little bit careful of oil. Do you have any idea what's happened at Cushing during the week? And do you feel this market is settling into something retail traders should be in, or do you think it's something they should be taking some care in?
Okay, all right. Let's do that, guys. I'm just going to share my screen once more. Now I've cleared all my commentaries off. Okay, so look, here we go. This is a chart. Hopefully, you guys can see this. This is a chart of WTI. It doesn't matter whether we look at WTI or Brent; they're pretty much all the same thing. And you can see how it was a quite nice trending market through September and probably half of October. Since that moment in time, since about mid-October, probably when the stock market started to move up, actually, you've had a shaky session really for the last 2 or 3 weeks in the oil market. Now, what do I mean by that? Well, if you look at some of the size of those bars compared to some of the average range of the bars in September and October, it's completely different, right? So when Paul was referring to it's really a trader's market and you need to be quite careful out there, this is what he's referring to. Crazy volatility. We went to a almost new closing high. It was a new closing high on Tuesday, up at almost $85 on WTI, and then the next day we promptly lost $4. Okay, so $4 out of 85. Those of you that are pretty good at maths will beat me to it, but that's somewhere in the region of a 5% move. Now, if you're trading Bitcoin, of course, that's basically a couple of hours work. If you're trading any other asset class in the world at that moment in time, a 5% move in a day is pretty dramatic, and that to me signifies that we're seeing, especially when you look at the previous 2 weeks of bars collectively, we're seeing significant volatility coming into market, which normally is a sign of some kind of consolidation / market top, short-term market top. So could we see the market trade down from here? I think it has to go to the point at which we find out where the real buyers are. We haven't seen that. There's been a lot of chatter, a lot of talk about deliverability of Cushing oil at the moment on the front contract. And if you look at the oil curve is very much a backwardated contract. So what I mean by backwardated, it means that the nearby months are trading higher in price than the market 12 months into the future. So if you wanted to sell your oil for December 2022, right now you get about $5 or $6 less for it than you would get today. So why would you do that? You say, no, I'll sell the oil if I have it available. I'll sell it today because it's a higher price. The reason why the market is backwardated is because they're trying to encourage people to bring oil out of storage and sell it on the open market now because there is a shortfall. Now, when you start to see this volatility pitch up, it's a sign to me when we've had such a big rally, we've got the volatility, there's talk about deliverabilities. This is like the opposite problem to the one we had all those months ago. Do you remember 18 months ago in the middle of 2020 when oil went to some crazy negative numbers? This seems to be the opposite side. Now we have a capacity problem. I know that Cushing is trading the storage facilities are at a percentage basis very close to a low, I think, of the last 10 years in terms of the oil that's available there. So is there a direct problem? Probably not. It's going to be mitigated. I'm sure they'll find a way around it. Could there be a problem around deliverability time of oil? Yes, they could for that December contract. And then you can see that start to work its way through the system as well too. So just bear that in mind, okay? This is why Paul is making those comments, right? So move away from thinking about a trend move into either much bigger spread stop losses where you have to give the market room to breathe, or else be very careful about your trade location, both from the buy and the sell side. This is a time to be clever about where you put it, where you put those stop losses, and where you place your trade entries. It doesn't require you to hit these sort of it doesn't matter, whatever happens, it's going to go up next week anyway camp. Right? Oil might well, and I have a long-term target much higher than where we are now, but at the moment, we're not seeing that. And if you've been following what's going on in the coal market, what's going on in the natural gas market in the States, you will see the significant sell-offs in both coal and natural gas that's affecting those markets, and that will feed into the oil market. Not directly, the correlation is less than it used to be, but there'll be some element of that coming in, and people who are taking profits in those markets or making losses, worst case, in those markets, will then be looking at their positions in the oil market, saying maybe I need to book something over there to cover those losses, or I need to be more careful with my positioning. So, okay, that's what we mean. Now, having said all of that, right, where are we looking at? Well, let's take this chart out down to a weekly and see if we can get any more information out of it, right? I'm just going to squeeze this up a little bit. So we're seeing the market for the last, 1, 2, 3, 4, 5, 6, 7, 8, 9. We've had 9 weeks up, and then we've had 3 weeks down. What's interesting about that is you think about that, right? So we've had 9 weeks straight up, and now we've had 3 weeks down. What happened the last time we had 3 weeks down? We began a 9-week bull run. Try and go and look for previous analogs. Look what happened. We had 3 weeks down. Look what happened next. The market basically ground its way higher. Okay, now the seasonals. Guys, check the seasonals out for oil. This is traditionally not a very good time for oil this time of year. At some point, those seasonals turn around, but not for another month or two, right? This normally kicks off about the middle of January to the beginning of February is when the bullish seasonals kick in for oil. So right now, we're in a seasonally weak period of time. However, the however to all of this is 3 weeks down. When we've seen that analog in the last couple of years, you go look for it on the charts. There's normally tended to be either flat or positive price performance after that. So now it's about trade location. This is what I'm saying to you, right? So think about trade location and where you can get involved in the marketplace, given we had a preceding 9 weeks up, which is pretty powerful. Okay, so that's what I'd be looking for here. I'd be looking for a trade entry, probably on the long side, but I need to make sure that I've got my systems in place and I've got my trade location really good. You can't afford to make a mistake. You make a mistake, you could be $3 offside within 24 hours, and that's not a good place to be. So my advice is trade location, but overall the market environment still remains at this stage positive. Bear in mind the seasonals are not positive right now, so you need to size accordingly. I hope that covers oil for you, Paul.
I thought it was brilliant, and I really do want to thank you for staying up and helping out. It's 11:15 New Zealand, Julian. I really appreciate you being here this late for us. I encourage you to get some sleep, mate, and we will you have a good day tomorrow, mate. Thank you very much for being with us. Look, next we're going to go to Lloyd and talk about indexes. Lloyd, are you with us?
Yep, I am here. Let me grab the screen.
Cheers, mate. Index Insights with Lloyd is coming up, and how they're looking this week, Lloyd?
All right, so I'm just going to cover what I've done last week. I'll jump over. So last week I've actually shorted Aussie dollar. I shared with everybody. Price actually retraced quite a fair bit, but I'm still in this position. And my next update is actually pound cat. So I've shorted pound cat actually pretty early in the week, and seeing that price actually retested the same zone and is still going down. Happy to see that, but I'm going to revise my take profit target. Instead of my usual 3:1. I have to respect the horizontal level, so I'll change it to 2:1 this coming Monday update. I'll update this trade. So let's hope that I'll be hitting my take profit. Now for this week, my analysis is more or less the same as last week. Dollar is the only one that I see it as bullish. Other than dollar, the rest is really pretty weak. Yeah. So my theme for this week is still the same. I'm going to try to long dollar against the other currency. Now, I'm saying that there will still be some other currencies whereby I wouldn't be touching. Now, the XY as it is, I would still say that it has plenty of space to go up, actually up until this level. Yeah, so we got quite a fair bit of room for it to grow until I would say about $96, then we need to be showing some concerns. Technically speaking, that would be it. Now, Kiwi, on the other hand, price is really consolidating and somewhat near a major horizontal level, which is $70. Don't feel like really touching this currency at all until it gives us clearer indication where it wants to go. Now, for the past 2017 till now, you can see that price actually hovers at this area. The moment when it hovers, it will actually hover quite a fair bit until it goes down again. So on saying that, my sentiment is that I'll be looking for Kiwi to actually break short, not to trade long. But as it is right now, since it's in a range, I won't be touching it. The Canadian index, more or less still the same story. Price is hovering at a major horizontal level, which is $80. Yeah. So I don't see any clear-cut direction. This is neither a range nor a trend. It's really just messy price moving about. So I'll be leaving this one out, Kiwi, until it shows me that it wants to break up or down. Now, yen is interesting. It has been consolidating near $88 zones, which is a huge area from the past. Yeah. So personally, I like to see tight consolidations. Yeah. So when price actually breaks during such a tight consolidation, it should break rather well. That means it will have what I call a waterfall movement. It will just keep on falling or keep on rising. Yeah, so I'll be keenly watching yen to see when it actually breaks this tight consolidation. Now, British pound, no doubt to me that it's falling. But the thing is that it has fallen to an area of concern. So you can see that this is where price actually reverses in the past. Yeah. So it is still quite a pretty bearish movement to me. So the upcoming week ahead, I might still be shorting British pound. What I want to see is that on the lower time frame, primarily the 4-hour time frame, I want to see a break and retest of sorts or any sort of lower high. Then I'll be happy to actually go into any pound short trades. As it is, I don't want to be trading when I don't see a very clear-cut cyclicity price action. Euro against very similar story as British pound, in the sense that this is no doubt on a bearish fall. Now, it has a bit of space to fall before I need to show some concern. Bear in mind that I'm actually on the weekly time frame, so any small space you see on the 4-hour time frame is actually still quite a significant. There still can be quite significant enough movement for me to actually go about. So on that, I'll still be looking to short the euro if any opportunity arises. Now, Swiss, I think for the past 1.5 months, I've been saying that price should eventually rise to 110, and then giving us a good bearish movement. So this time around, this is the exact movement which I've been actually waiting for 1.5 months. Happy to be in some of these trades already. So now this is a significant, to me, a significant enough bearish rejection of this level and the trend line. So in the upcoming weeks ahead, I suspect that this movement will actually continue on. And the last one on my list is actually the Australian index. Yeah. So price indeed has come up to, now previously this was the previous level that I was looking to short. So indeed it did reject. Yeah. So with that in mind, I'll still be actually shorting the dollar index, the Australian index. Yeah. So the next major level that I'll be looking at is $70. So in the upcoming week ahead, I will be actually trying to scale in Aussie dollar. So I'm still trying to trade the strong against the weakest. But seeing as both are, I won't be seeing any sort of significant retracement, I think. So I'll be off to trade a trend line. So on Monday morning, if there's any sort of consolidation followed by a bearish break below the trend line, I'll be happy to actually jump into it straight away. Then my very first trade, I'll be moving it to break-evens. The next trade whereby I'll be looking to trade is actually dollar Swiss. Yeah, so again, it's something dollar. I'm loading quite a fair bit of position on dollar. Now there's two movements whereby I can see dollar happening. The first one is being rejected at this level. Then I'll simply be trading here. Yeah, so it's still the same kind of structure which I'm trading previous support, previous resistance, now turn support. Or I'll be waiting for price simply to break above the level, retest. So still the very similar movement that I'm looking to trade. So that's about it for this week. Hopefully we'll be getting to some good positions.
Cheers, Lloyd. Nice to have you back live as well, mate. Thank you very much. And yes, Next up, we're going to have Orlando looking at the US dollar, followed by Gordon having a look at US stock markets, and Geoff doing the technicians 2 cents worth. So lots to come. Do stay with us. It is another show where our team really get into what's a really interesting market. Things are happening, and they're not happening in a way that I would say was typical. I think we see the US dollar going up and gold going up when gold valued in the US dollars suggests the gold move is quite strong. It's an interesting market to be in. Let's get some more perspective on what's going on with it. I'm going to get Maya, first of all, to share Orlando's US dollar video. Maya, are you ready?
Hello traders, Trader O here, and let's have a look at the US dollar. So after last week, super heavy inflation data out of the US, the US dollar rallied, right? And it broke with that massive level that we have been looking for a while now, those pandemic lows, right? Those March 2020 lows. The reason that the USD rallied on high inflation is because of, fundamentally speaking, what central banks have to do to face inflation. And the tool that central banks use to face inflation is to hike rates, which is bullish for the given currency, right? So that's why we saw that big rally on the USD. From the bottom to the high, we're talking about a 1.45% move. So what to expect next week? What I'm going to do next week? What I am looking for next week? Right on the daily, we are above those September 14th or September 2020 highs and those March 2020 lows, right? The next key level on the DXY is the 95.70 level, or this previous base. So very key level there. We are still, we are still from that to get there. If we go back to the 4-hour chart, what I'm looking for on Sunday open, right, for some of you might be Monday open, is a dip to those previous broken highs. We're talking about October, September highs, right? Those flat highs that were capping the upside on the USD. So we are bullish. I'm bullish on the US dollar, right? Right now, there's absolutely no setup to buy the USD. We are still looking at a pullback towards those previous broken highs. So my power buy zone, let's call it like that, power buy zone should be around the 94.50 to 94.70 levels. So a dip to this previous broken highs would give me a trigger to look for longs on the USD. So where would I play a long on the US dollar? Remember that the only scenario where I would play longs at the open is Sunday or Monday for some of you would be a pullback on the USD, right, on DXY towards those previous broken highs. We're talking about, again, October and September's highs, right? So let's have a look at the markets that I could play a long on the US dollar. Now, the Euro USD, I could see a short on the Euro USD, which would in fact be a long on the US dollar on a pullback towards those previous broken lows on the 4-hour chart. If you look at the top left of my chart, around the 115.50 level, that would be a nice short on the Euro USD, which would be a long on the US dollar on a pullback on the DXY, which I already talked about. Now the Kiwi, right? The Kiwi versus the USD, again, a pullback towards those previous broken lows, and I actually like this is my preferred setup for US dollar longs, right? On a pullback towards the 70-80 level, given the fact that the Kiwi showed a ton of weakness last week and closed about actually let's have a look how much closed uh, almost 0.4% lower than last week's lows. So a pullback towards those previous broken lows or the 70-80 level on the keywords of the USD would in fact give me a nice short on the Kiwi USD, which would be a US dollar driven trade on a pullback and a continuation of a US dollar rally. So that's what I'm looking at for next week. Trade safe, and I'll see you around.
Thanks very much for that. That is Orlando talking about US dollars. It's great to have different experts looking at different markets in some detail. Next up for us is Gordon Scott looking at US stock markets. He'll undoubtedly log them back a little bit into some Forex stuff as well. Great piece always from Gordon. And he'll be back on Monday night on YouTube and live as well for the US Open, where he will take a trade for you guys and let you trade that with him. Am I ready to go with Gordon's video?
Hello everyone, Gordon Scott here with a weekend update for the U.S. stock markets. I'm looking at this chart here that shows all four of the major indexes, and you can see that over the past few weeks, they've had a strong upward trend. And just this past week, what we did was complete a bounce on that trend. So came down a little bit, and you can see all of them bounced up. The one that bounced up the strongest was the NASDAQ. But notice this chart here. This is the comparison between the S&P 500 on the top line up here, and then one below it is the volatility index. That's the pricing of options, which give us a prediction of how far or fast stock prices are going to move. When you have a bullish market, it should be the case that the VIX keeps going lower because they're sort of inversely correlated, right? Well, what we've seen over the past few months is that the S&P 500 index has indeed been trending higher, but the VIX has not been trending lower, at least not until these past couple of weeks. We made a brand new low. We kind of sat there, but this week we made a new high. So that's what the yellow arrow is pointing out. And it's kind of interesting. A new high on the VIX, but not a new low on the S&P 500. The fact that both of these are going up means we've got a divergence between the price of options and the price of stocks. That usually means there is more volatility up ahead. But in this case, it might not be volatility to the downside. It might actually be volatility to the upside. In other words, we could get some big moves up in U.S. stocks. If we look at this next chart, this is a comparison between the Aussie yen and the NASDAQ, which, as you've heard me say many times, I'm sure that these two are usually highly correlated. They were anti-correlated for about a 1 or 2 month stretch over the summer, but they are coming back into correlation now. And you can see it here. This is a 30-minute chart of over the past week and just the price action over the past week. And we can see that we ran up, we ran down, kind of dipped early in the week and sort of leveled out. And then Friday, very clearly, right at the open of the U.S. market, up went both the currency pair and the NASDAQ 100. So that tells us that buyers have returned. Buyers are kind of ready to come back and bargain shop, buy up the dips, and so forth. I would expect, therefore, that through the coming week, we would see stocks on the rise, not just always straight up, but generally trending up, and some of them going up strongly. Let me show you which ones that I think might have the best chance. If I look at this chart, which has the various sectors, right? Each one of these is one of the sectors. E for energy, Y for consumer discretionary, right? And the B is basic materials. Those are the top three. As you can see, the energy sector is just sort of flat across the top, but the discretionary is ready to bounce, and the basic materials is already on the way up. So the basic materials play and the discretionary, why should both of those be going up at the same time? Well, because the discretionary sector right now is heavily influenced by a company by the name of Home Depot. They're the home improvement store, which really tends to benefit from inflationary news. basic materials, that's the sector of stocks that make things that people use for construction projects and building and supplies for manufacturing of all kinds. That sector is heavily influenced by, yes, you got it, inflation. So there was a lot of inflation news this week that indicators and measures of inflation were higher than they've been in a long time. And so the U.S. is experiencing real inflation. And as a result, investors are responding by looking at sectors which tend to benefit from inflation. And right now, that's the consumer discretionary and basic materials. So what would that look like? Well, here's one chart that will show you kind of where the epicenter of all this is. This green line here represents the home builder industry. So people that are in the business of building residential homes, single-family homes in the United States, and people who sell products that those single-family home builders or owners would buy from, the home improvement stores, Home Depot, Lowe's, right, are trending up very strongly. As you can see, the green line is the whole industry to be, collectively, but this chart up top, this is actually Home Depot. You can see Home Depot ran up during the month of October, has flattened out. Why have they flattened out? What's happening? Earnings are going to occur on Tuesday for Home Depot. So basically investors are saying, well, we don't know. We don't know what kind of quarter Home Depot probably had. We think it was pretty good, but we're not sure. So if the news comes out that Home Depot bested expectations, then you can bet that that stock will jump and head higher and kind of resume the trend that these other stocks are on. Lind is the company that is the largest company in the basic materials sector, is on a very strong upward trend right along with the home builders. So if Home Depot comes back with good earnings report, you can bet that they will trend higher, sort of catching up with this trend. Yeah, they got out ahead of it a little bit, and the rest of the industry had to kind of catch up with them. But that's what's going to happen. It'll take off if the news is good. If the news is bad, it might affect all of these stocks. So we would see. If I had to guess, I would guess that the news will be good, better than expected for Home Depot. And why might that be? Well, if you look here at this chart here, we go to the currencies to look at it. Look at the chart right in the middle. The euro and the U.S. dollar, euro dropping, right? Big old drop early on or in the middle of the week, and then it's kind of slowing. But generally speaking, it's trending down. That's kind of strange because usually if a currency, in this case the US dollar, is showing inflationary tendencies, wouldn't it be the case that people would be less in demand of it? It's inflation, it's losing its purchasing power, right? What do we have here where we have clear signs of inflation in the US and in the US economy, and yet the dollar is strengthening? Now, it could be that is a huge warning signal that markets are getting ready to collapse and people are already moving money to cash and putting it there as a safe haven. I don't think that's what's going on. I think that what's happening is that the inflation in the U.S. is just signaling that the U.S. inflation is greater than U.S. inflation used to be. But inflation isn't just happening in the U.S., it's happening all over the world. And in the Eurozone, it's happening even more. And that's what we're seeing here is that, sure, the dollar is weakening, but the euro is weakening more than the dollar. So the comparison that makes this chart look like it's going down. But it's just the comparison of the euro to the US dollar. You look over in the Australian dollar compared to the US dollar, it did go down, but we got a pretty strong bounce on Friday. And I think that the fact that the Aussie has a little bit of strength and the euro basically has none means that my favorite pair, the euro Australian dollar, is probably ready for another leg down. And so that's why I wanted to show that chart. Last of all, I mentioned this chart. This is a comparison between IWC. It's an ETF that measures microcap stocks. Okay. I just completed a class this weekend on low-cost growth stocks. It was a great class. We had a great time. A lot of fun information shared there. But if you look at stocks that are micro-cap or small cap and that are, potential big growers, when's the very best time to be getting into them? The answer is whenever this measure, IWC, divided by SPY. So it's the relative strength between the micro caps and the large caps, right? Which one's doing better? If micro caps are doing better than the large caps, then that's people looking for opportunity. They're rolling the dice. And when money starts flowing into seeking opportunity, that's when you want to be trying to find those opportunities in low cost growth stocks. So right now we are, since the beginning of November, the past couple of weeks, we're up above that red line, the moving average of this relative strength measure. And as long as it continues trending up, it's still going to be a good time to go opportunity shopping. When it gets below, as it did in October, you kind of back off. You might still be opportunity shopping, just don't be so aggressive about it, right? So anyway, that's the situation we're in right now. And I think that what that means is through the coming week, there's still going to be some really good opportunities in the U.S. stock market. That's the weekend update from me, Gordon Scott. Till we talk again, take care, trade well.
Great to hear from Gordon. Obviously had a big weekend running the low-cost growth stocks event on Saturday, and some interesting stuff there. He'll be back on live just before US Open on Monday morning US time and Monday evening Singapore time. Geoff, my gosh, it's nice to speak to you, buddy. It feels like we've been doing this for a little while, and another fascinating look at the markets from the team. I'm really looking forward to see a technical view from you, mate. What do you think may lay ahead for us this week?
It's always fascinating to do the Sunday market update because of the variations that you get among all the asset classes and indexes and currencies and all the rest of it. So I'll take a look at the technical aspect that I'm seeing, and I'm only looking at 3 charts this week. First one is Kiwi CAD. Now, Kiwi CAD is it's a solo this week game changer bar that I actually have on my radar. And if I give you a bigger overview of what's going on here in Kiwi CAD, it's a bit mixed, this chart, to be fair. But I do see a couple of things that point in a direction. And one of them is this trend line here. That has been broken. And then we've had a bounce off that, but only as far as this resistance level. And that's a little bit more obvious, if you like, on the weekly chart. The thing that I like about this is that we've been in this range between 86.5 and 89.5, I think it is, round about there anyway. A few false breakouts and a massive one, but intrinsically we're entrenched in here, at least since May 2020 or March 2020, around about that point in time. So it doesn't like to get outside of that area. And when I see ranges, I kind of perk up a little bit, because when I get to the top, I like to see them go to the bottom. This is one of those cases, and it has delivered a game changer bar on a resistance level. For that reason, my bias this week on Kiwi CAD has to be short. Now, am I going to trade that bar per se? Well, no, I'm not. And the reason is I'd have to enter around about there somewhere, which gives me a risk of about 150 pips and a potential reward till I get to the bottom of that range of only about the same. So 1-to-1. I want a little bit better on that to trade a bar such as we have been printed here. So I'd like to see on maybe a daily chart on maybe Monday, Tuesday, daily chart come back here, give us a lower high, even Tuesday, Wednesday, give us a lower high, and then we can look to trade it short. On the 4-hour chart, maybe the same thing, but I'm not ready yet to trade it, but that's the direction that I think Kiwi CAD is headed this week. Now, I tremble whenever I put this chart on screen, because it means I have to shudder. It's a currency pair I hate. It's dollar yen, but technically this week I see it as at resistance. Now, I know we've spoken a lot in the show about the dollar, and I fully agree with everything that's been said, apart from one thing. And I see the dollar index at an inflection point, frankly. I've got a resistance trend line, I've got a support trend line, and I've got a horizontal level, which is pretty clear in recency coming through this area, which is pretty much where price got to on by the end of the week. Now, look, this breakout was clear. There's no question about that. And it went straight up and didn't pause until Friday came off a little bit as it hit that resistance level. Now, my thought process is that this week we're going to see a pullback. I don't know if we can get back to this level. And I think Orlando was kind of going in that direction as well. I don't know if we can get back to that level, frankly, because once they start to buy these dollars, they tend not to stop for a fair bit. And there are targets well above this level, as was pointed out earlier in the show. But I see this week as a pullback week. If it does come to there, happy days. And I'd be more than willing to trade anything that points in that direction. And here I see on dollar yen a clear top of range scenario. Now I call the channel a range, but I also see a horizontal level sitting there. It makes perfect sense to me that this can come off and maybe go back to this level, not the level that I spoke of before, but certainly back to this level here, which is still monthly pivot, of course, and around about the 113 mark. That would give us 100 odd pips to play with. And again, on a smaller time frame daily chart, 4-hour chart, I would be looking to trade this short this week, not long. It would want to be a bloody good setup, though, because I hate dollar yen. It's a very, very difficult currency pair to trade. But technically, that's exactly what I'm seeing. The trade of the week for me is Aussie Swissy. Now, I'll go through this pretty swiftly, but essentially what I see is a massive inverted head and shoulders sitting here, to be fair. And if you drew a line through the neckline, which I haven't done, but I'll do that for you now. If you want to call that the neckline, you could. There's probably a slanting line that goes down there. But it has been broken and retested. I'm going to get rid of it for a second. But moreover, this is a monthly chart I'm looking at. And long-term trend line that goes back to 2014, break, retest, and there's that inverted head and shoulders sitting there quite clearly. So the bias, to my mind, is for a bullish Aussie Swissy. And then I come to the smaller time frames, the weekly here, where we've got, again, a trend line that was broken and retested. You probably can't see that clearly. I'll go a bit tighter. And now we're pushing off the backside of that trend line. Also, in a company with an ascending channel, we've also bounced off the bottom of that. Daily chart will show you that we've come back with a vengeance on Friday with that big bull bar. Now, I'd love to get into this early in the week, frankly. Any pullback here, I think buy a dip is my go for Aussie Swissy, and just keep buying it until it gets to the top of that range again. In my humble opinion, that is, as I said, the trade of the week. Any pullback here would be suitable for a buy on Aussie Swissy. That's my technical view for the week and my 2 cents worth, mate.
Cheers, mate. It's interesting. Every week your 2 cents worth is worth a few more cents than that. Thank you very much for it, mate.
Cheers.
Big night ahead, mate, as New Zealand beats Australia in the 2020 World Cup cricket final.
Look, I don't think I can stay awake, to be fair, but thank God for Fox Sports. They'll put up a replay fairly early, I would imagine. I'll jump onto that one, I think.
Well, I'll send you a message, whether you want to watch it or not, mate.
No, don't do that. I'll turn my phone off.
I'll ruin the replay. I know what you're saying. Hey, mate, thank you very much for your patience and for your patience. It's always nice to have you anchor the session and bring it up with the technical stuff. I think a lot of people are, obviously it's a big part of what we do, the technical stuff, and it's nice to get here and to get it summed up. Been a great show from the team, if you ask me. Lots of stuff. There's lots of stuff going on in the market and lots of different views for you guys to have a look at. Take your time. We'll be putting out the cut-up sections one by one. Those sections, they'll be in about half an hour from You've got the whole of this show to have a look at. You've got the little ones one at a time if you want to have a look at them. I'd like to thank the team very much for the openness, the honesty, and the generousness of the sharing. Makes the show what it is. So thank you guys to the team and to you guys that you're going to use this information in the next week to try and make some more money. What I'd encourage you to do is to stay calm and make good decisions. Take your time. When you stay calm, make good decisions, it all tends to work out. Thank you very much for joining us. We'll see you during the week. Cheers. I'll be back next Sunday with the team. Thanks, everyone.